We all know that the world of cryptocurrencies is filled with surprises and shocks. One day you hear a good news and the other day comes with a bad news. It's a cycle, but this doesn't mean you should give up. Not yet. Because Ethereum will stand again and you will be amazed with the success it brings. So what's happening to Ethereum? Why is Ether seeing a massive price drop? What will happen next? Let's find out in today's video. Hey guys, and welcome back to Investing Few. If you are new to this channel, please like, subscribe, and press the bell icon to get new video updates. Make sure to do so if you want all the latest news on cryptocurrency. So, without any further delay, let's jump right into the video. Bitcoin, Ether, and other cryptocurrencies are trading lower after the People's Bank of China called for a stricter crackdown on virtual currency dealings. Ether, the second largest cryptocurrency by market value, is changing hands near $1,920 at press time, the lowest level since May 23rd. The token powering Ethereum's blockchain is down nearly 15% on the day and appears on track to test the 200-day simple moving average support at $1,872. Bitcoin is trading 10% lower near $31,850, extending last week's 8.7% decline. Other top cryptocurrencies, including XRP, Cardano, and Polkadot, are nursing losses ranging from 5% to 10%. In an announcement early today, the PBOC said major financial institutions must stop providing trading, clearing, and settlement for crypto transactions. While China's anti-crypto stance is well established, the latest statement comes after consultation with Alipay and major banks including the Industrial and Commercial Bank of China, Agricultural Bank of China, Construction Bank, Postal Savings Bank, and Industrial Bank. The central bank asked for prompt discontinuation of payments channels to crypto traders. Alipay, the Agricultural Bank of China, and Postal Savings Bank have put out statements saying they will take necessary steps to prohibit virtual currency-related business activities. PBOC's strongly worded communique has bolstered concern of a stricter regulatory crackdown. Crypto markets tanked last month on the back of environmental concerns related to crypto mining. China's crackdown and fears of an early scaling back of stimulus by the U.S. Federal Reserve. China reiterated its crypto ban last month, citing dangers associated with speculative trading. On Friday, the government intensified pressure on cryptocurrency mining by ordering the closure of 26 suspected mining projects in Sichuan. The Fed unexpectedly brought forward the timing of the first interest rate hike to 2023. Let's compare this trend with 2017, the first sell-off and bear trap. In 2017, from June through July, the Ethereum price dropped 70% to $155. This resulted in many of the early skeptics proclaiming the market was finished. However, ETH stabilized and went on to recover. In 2021, a sharp correction from the February high, ETH lost 40% over 9 days, trading from $2,129 down to $1,287. Again, the Ethereum price recovered. Mania phase, media attention, enthusiasm, and greed. In 2017, from the August low, ETH steadily increased and by December was 540% higher and nudging $900. This was around the time the tabloids and mainstream media started to cover cryptocurrencies, and the general public became more aware of their existence. In 2020, while nowhere as impressive as 2017's bounce, within 5 weeks the Ethereum price had recovered from its February low and firmly approaching the next phase of the cycle. In 2018, in the first 2 weeks of January, the Ethereum price more than doubled, gaining 130% from $661 to $1,529. This proved to be the top. This brought many of the earlier skeptics back into the market, chasing the price higher. The FOMO-fueled rally eventually leading to a blow-off top. In 2021, in the 2 weeks following the 26th of April, ETH extended higher by 107% to this year's peak of $4,646. This may or may not prove to be the top. Denial and bull trap. In 2018, the first leg of the crash wiped 76% from the Ethereum in a week. The week after, a knee-jerk 86% bounce followed. In 2021, in May's wipeout, ETH dropped 63% over the course of 7 days, gaining 75% in the 7 that followed. fear and capitulation. In 2018, after initially bouncing, Ethereum turned lower again. The second leg lower resulted in 71% of ETH's value being wiped out in the next 2 months. Eventually, the Ethereum price bottomed out in December 2018 at $79.60, some 95% below its 2018 peak. It would take 3 years for ETH to make a new high. In 2021, so far, Ethereum is down 35% from the $3,007 top of the reactive bounce from the 23rd of May low. I'm not suggesting it will, but if ETH follows the 2018 analog and loses 71%, it would take the price back to $900. Although this seems pretty far-fetched if you are focusing on the $4,464 top of last month, it was a price last traded on the 11th of January. It can also be remembered as the top of the enthusiasm and greed phase in 2017. It goes without saying that past performance is no indication of what happens in the future. However, manias and speculative bubbles have a habit of following similar paths. This is much less to do with the price, but more about human behavior and investor psychology. If we talk about it more, Bitcoin is very much responsible for the bearishness seen in the cryptocurrency space, as it currently struggles at the $32,000 level. Bitcoin triggered a massive move lower in other digital assets, such as Ethereum, Doge, or Cardano. An interesting aspect regarding Ethereum is its price correlation with the price of GPUs. Chips have seen a sharp increase in demand as they are used in computers to mine cryptocurrencies, such as Ethereum. A close look at the price of used GPUs and the price of Ethereum reveals a tight, direct correlation. It would be interesting to see if the prices of GPUs will decline too, now that Ethereum is down sharply from the highs. So far, they did not, fueling hopes of Ethereum bulls that the market will reverse. Ethereum is striving to lay the red carpet for Ethereum 2.0, one of the biggest upgrades in the history of any public blockchains. 2021 has undoubtedly been a year full of progress as Ethereum aims to shift from the publicly dreaded proof-of-work algorithm to the much-anticipated proof-of-stake algorithm. While there may be a few projects that beat Ethereum in adopting proof-of-stake, they miss the network effect, ease of development, and a secure platform that Ethereum is known for. Every year, Ethereum introduces necessary improvements to its underlying architecture with periodic upgrades, and this year we get to see the London and Berlin hard fork. Both of these upgrades introduce a new transaction type to the network and solve the age-old high gas fees and its inherent network congestion problem. While this in itself is something to celebrate, does this mean Ethereum will become more scalable? Do we finally move on from the myriad of scalability problems such as high gas fees, low throughput, network congestion, and more? Well, the answer to these questions is a little more complicated. Berlin and London hard fork are not enough. Now let's address the elephant in the room. Both the London and Berlin hard fork improve the overall experience of using the Ethereum network. It turns Ether into a productive asset by promoting it as an exceptional store of value with a deflationary characteristic. However, it doesn't directly make Ethereum more scalable. One of the main points of both the upgrades is that they lower the gas fees. Note that fees are established on supply and demand, and not how the marketplace works. Although the upgrades optimize the structure of the marketplace, however, it only does so at a minor level. By introducing the new transaction types, users won't have to overbid the gas fees, but this could be countered by users willing to pay more for transactions. Both the London and Berlin hard forks do not directly improve Ethereum's scalability problems. Most of the proposed features have an indirect effect. But what if I told you there are solutions that could definitely make Ethereum much more scalable to handle large-scale applications? Layer 2 scaling solutions to the rescue. Layer 2 is the shared term for solutions designed to help scale dApps by managing transactions off of the Ethereum mainnet, in this case, the Layer 1, while leveraging its decentralized economic security model. A lot of Ethereum's scalability problems come from network congestion and high network transaction fees. Transaction speeds tend to suffer when the network gets busier. That ruins the user experience for various dApps. With the network getting busier, gas prices tend to skyrocket as senders aim to outbid each other. The London and Berlin hard fork are the necessary updates that could set the foundation for a better user experience. However, they do not come close to the scalability and flexibility offered by Layer 2 scaling solutions. Layer 2 scaling solutions are groundbreaking and could essentially change how people and businesses use blockchain technology. The upcoming London hard fork sets the road for ETH 2.0. However, until Ethereum 2.0 is officially live, Layer 2 scaling solutions are our best option. And with that, we come to the end of today's video. While this may be a tough time for Ethereum, investors are still hopeful that this phase will be over soon, and new Ethereum upgrades will come with much more changes that will result in a positive price movement. So what are your thoughts Ethereum price drop? Tell us in the comments. Also, if you enjoyed this video, do not forget to smash the like and subscribe button. Thanks for watching.